This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Welcome to episode 14 of Value Investing. In this episode, I want to talk about this concept of long-term investing. I'm going to discuss why long-term investing works and why so many people cannot follow this long-term investing. It is not easy for sure. If you think of yourself as a value investor, probably you think that you're doing long-term investing, but if you look at your investment track record, you probably realize that you're not doing long-term investing. So let's have open discussion here in this episode and see how you can develop this strategy for your portfolio management. Before we get into the details, if you haven't already done so, please subscribe to my channel, and 5-star review always goes a long way. Without further ado, let's get started. Let me pose you one question. Who are the richest people in the world? If you look at Fortune 500 list, then you'll see at the top of the list Jeff Bezos from Amazon, Bill Gates from Microsoft, Warren Buffett from Berkshire Hathaway, Mark Zuckerberg from Facebook. These are the most successful people, at least financially, in the world. And what do they have in common? So one common thing that I'm just asking all these questions to see how you can become successful. They built a successful company. Jeff Bezos built Amazon within his lifetime, and it has been incredibly successful that dominated the commercial industry. And Bill Gates built Microsoft and so on and so forth. So I think these are the successful stories that everyone knows about and everyone talks about. But let me tell you two things that people do not talk about often and they don't tend to focus on. Number one, they have had extremely concentrated portfolio. Jeff Bezos' significant net worth is tied to Amazon, Bill Gates tied to Microsoft, Warren Buffett to Berkshire Hathaway, Mark Zuckerberg to Facebook. So that's one aspect. Another aspect is that all of these people have held on to one stock for many, many decades. So the reason why I ask this question is to show that why long-term investing is so important for you. And if you're right, you can make tons of money from your long-term investing. So I thought it's important to bring up this point that all these successful people have held on to their stock for many decades and they have been a long-term investor regardless of their intention. They could have sold their shares, but they haven't. So that's why they became so rich. Another story that I want to talk about here is that when Warren Buffett started his first investment partnership in 1956, the stock market was there. So if you were an average investor back then, and if you had invested your $10,000 in the stock market, overall stock market, and the money now, if you haven't had sold any of the shares throughout 62 years since 1956, by now, June 2018, you would have had $3.8 million. That's a huge amount of money. So you could have earned 367 times of your initial capital, which translates into 10% annualized compound return if you had reinvested your dividends along the way. So it's a huge number. Then why don't we see a lot of millionaires nowadays? Like if you look at people at Warren Buffett's age, you don't see a lot of millionaires. Why is that the case? It's because people haven't invested their money for the long term. So that's the point that I want to get to. And I think that goes to show that why long-term investing is so important. So let me go over 4 explicit financial benefits from long-term investing, and also go over 3 implicit benefits from long-term investing. Number 1, you can earn dividends along the way if you are a long-term investor, and dividends will contribute to your overall returns. And people are not patient to wait for dividends to come out in many cases if they are a trader or short-term investor. But I think this is one of the best way to make your money or investment grow. If you put your money in your bank account, you're probably going to get 1% to 2% interest rate right now in 2018. But if you invest in the right stock that pay out good amount of dividend, you can make a lot more money. And relatively, these stable stocks are not that risky. So if you do your own homework, you'll realize that there are a lot of good stocks that can be the replacement of your bank interest rates. Number 2, you're not going to pay high capital tax if you're a long-term investor. So for short-term investors, they have to pay regular income tax. So if your tax bracket is high, and if you're a high income earner, then you have to pay high rate of tax if you sell your securities within 1 year time period. But if you keep your stock in your portfolio more than 1 year, your capital tax is likely a lot lower. So this is a big amount of money if you're selling your stocks at the end of the day, and if you have capital appreciation. So this is a huge benefit, I think, that you have to always consider when it comes to investing your money. Number 3, this item is also related to tax. Since you're a long-term investor, you can defer tax until you sell your securities. So this is going to have a huge impact on your compound interest and compound earnings. So if you don't sell your stocks for, let's say, 10 years and 20 years, all the tax that you're supposed to pay for unrealized gains are compounded along with your initial principal amount. So if you do buy and hold strategy and don't sell your securities for a long period of time, then you don't have to pay tax, and tax portion of your investment is going to compound over time, and it's going to bring you tons of money along the way. That's why it's so powerful. This is so powerful if you think about compound effect. Number 4, you don't have to pay transaction costs. So nowadays, transaction costs has gone down quite significantly if you use discount online broker, but still there is a cost that you have to pay whenever you're making a trade. So if you do a lot of frequent trading, you might think that the cost is nothing, but it's going to add up, and also compound effect is going to play a role if you pay some amount every time you're trading. So try to minimize the number of trades in order to prevent you from paying a lot of money to your brokers. So it's good for definitely for brokers, but it's not good for your investment portfolio. So these are the 4 explicit financial benefits that you have to think about when you are investing your money. And if you're a long-term investor, you definitely have huge advantage over other investors because you can earn a lot of money from dividends, and you don't have to pay high tax rate to the government. You're actually doing it something good for your government, but not good for your portfolio. And you don't have to pay tax for a long time, and deferred tax is going to come as a benefit to your portfolio, and over a long period of time it's going to be a huge amount. And finally, you don't have to enrich your brokers, but instead you can enrich your portfolio. So these are the 4 explicit financial benefits as a long-term investor. There are also 3 implicit benefits of long-term investing. First, you're going to set your apart from the crowd because most people invest their money in the short term. They buy and sell the stocks based on their emotions, and they do that all the time within short period of time, less than 1 year. And if you become a long-term investor, you can do something called arbitrage. When a lot of people focus on like quarterly calls, you will see that underlying business and brand value still are intact, because a lot of people sell their stocks based on one bad quarterly earning during the quarterly calls, and that's going to put a lot of pressure on stocks. But if you're a long-term investor, you know the business has a good underlying business model and has long-term competitive advantage, then you can buy the stocks at cheap price when people are selling their stocks based on short-term outlook. So that's going to give you time arbitrage opportunity, and you're going to make more money than other people if you can invest in the long term. So you can differentiate yourself from other people, and you can potentially earn alpha in the long term. Number 2, you don't have to be right twice. So you can be right only one time and buy and hold, and you can make tons of money. But if you buy and sell, if you do frequent trading, you have to be right multiple times. Then that's going to significantly reduce the probability of you becoming rich. Think about it. It's a pure statistics. If you want to buy and sell, that you have to be right when you buy, when you have to be also right when you sell. But if you are a long-term investor, if you buy at cheap price, you just want to be right one time and buy and hold, and you can make money over the course of your investment time horizon. Number 3, you can sleep well at night. So think about daily traders. They have many computer monitors on their desk, and they want to be up to date every single second. It's just crazy. They have multiple monitors and they want to be updated all the time. They turn on their CNBC news all the time in the background, and they want to know every single detail about what's happening within the company. If there's so much information, they don't even know what's important, what's not important. But if you're a long-term investor, and if you care only about durable competitive advantage that is behind the company, then you don't have to worry about every piece of information coming to you. You can become a long-term investor, and there's going to be always negative articles about the company that's going to put some pressure on the stock price. But if you are a long-term investor and look at the 10-year or 20-year time horizon, all these negative articles and news might not be relevant. You will only focus on what really matters in the long term. So I talked about 4 explicit financial benefits of long-term investing. And also I just talked about 3 implicit benefits of long-term investing. So there are 7 benefits that I talked about. Despite all these benefits, now the question is, why don't so many investors follow the long-term investing advice from Warren Buffett and from all legendary investors? So let me just go over in that regard why long-term investing is not so easy. Number 1, it is not easy because it is so easy for you to trade. Trading is at your fingertips. A lot of people are long-term investors when it comes to real estate because they want to buy their first home and they live there for at least 5 to 7 years before they make a transaction. And transaction cost is enormously high for real estate, and you have to go through a lot of hoops, a lot of obstacles in order to buy or sell your house. So that actually forces you to become long-term investor. And the transaction cost is very high for real estate, and it's not really good for investor, but it actually can function as a good thing for investors because it forces many of these people to stay in the long term. But if you look at the stock market, it is so easy. Actually, it's good for investors in that sense, but it actually is not functioning as a good thing for investors because they trade too often. They just go online, and if negative news comes out for the stocks that you're holding, then you can easily trade at your fingertips. So that's why people are tempted to trade their stocks in their portfolio so easily. Number 2, I talked about miss the market in my previous episode, and people get influenced by miss market too easily. When market is going up, people want to cash out their investment, and they are so tempted to sometimes jump on the bandwagon and buy at the high price. And when market is going down, everyone panics, and miss the market is giving you a lot of pressure to sell, and you want to get out because you're in a panic mode and you want to sell, and things are going bad and the world is coming to an end, and you believe all these negative sentiments and you sell under pressure. Number 3, there are just too much information out there. Earning calls are happening every quarter, and there's always announcements from the company, and there's always so much information about negative things within the company and also positive things in that sense. That actually captures your eyes because you have invested significant money in the stock market. You always log in to your whatever web portal that you are using. You can easily find so much information, and stock symbol is there. You can't really escape from watching this stock price going up and down every day because you have a smartphone, you have a laptop. The information is so easily available for you to look at. So that's one of the reasons. I think this makes really hard for undisciplined investors to stay in the long term. So given what we have discussed so far, the benefits of long-term investing, and also why it is so hard for you to become a long-term investor, what kind of strategies you should implement for your investing? Long-term investing is very simple. You just put your money in a good company with a durable competitive advantage and put it there for the long term. It's very, very simple idea, but it's hard to implement. Think about going on a diet. Think about trying to losing a weight. There are so many people who are trying to lose weight, and there are many different strategies they can do. But what really fundamentally works is two simple idea. Eat less, do more exercise. There's no other things that can be more effective than these two simple rules. But people think about different diets, different ways to lose weight. This is very simple rule, but people just cannot follow because they are not easy to implement. I think of long-term investing in the same way. It is very simple. You put your money in a good company for the long term, but it's not easy to implement because there are just so many temptations that can come to you to sell your stocks in the short term. Warren Buffett once said, quote, "Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges to get other people into trouble in investing." The message that Warren Buffett is trying to convey here is that you have to have a temperament to be in the game in the long term. And you need to have patience. It's not a matter of IQ. It's not a matter of how smart you are. People can calculate intrinsic value with a very simple formula. But what matters is be patient when it comes to buying the business, and be patient when it comes to putting your money to work for a long period of time. Okay, that's it for this episode. I hope you learned something out of this episode. If you want to leave any comments or if you want to leave reviews, please do so on valueinvesting.blueberry.net. I'll leave the link in the description box so that you can go there and leave your comments. Thank you very much, and see you next time.